Well, we really think that once people start to realize the implications of Trump's planned heavy deficit spending, infrastructure, military, tax cuts, that the enthusiasm for U.S. dollar assets is going to decline somewhat. We don't need the dollar to adjust downward dramatically. We just need to have it stop going up. And that'll give emerging markets room to breathe in 2017.
If you're calling the dollars incorrect, is it game over for emerging market investors?
Not necessarily. They still have demographics on their side. A lot of them are big commodity exporters. So you have countries like Brazil and Russia that are big oil exporters. You have places like Indonesia, big thermal coal and palm oil exporters. So if inflation trends establish themselves, some of those commodity exporting emerging markets can do very well.
How do you think about China at this point? I mean, with the threat of a looming trade war out there, I mean, do you favor Chinese companies that are focused on the domestic market in China?
I think those are going to be the ones that have the best success in an inflationary environment in 2017. Those strong brand names locally that are serving the growing domestic demand, consumer demand in China will do well. They have enough growth to outpace inflation, and they have strong brand names that allow them to put through price increases as inflation picks up.
The EEM, David, is the biggest. It is the most liquid and probably the most commonly cited of the emerging market ETFs. But do you like it as a way to invest? And I'll tell you why. I think it's a little misleading. We're just talking about China. 9 of the 10 top holdings in this ETF, as you probably know, are China, Korea, or Taiwan. You're heavily exposed to tech and Asia. You got a South African country kind of thrown in there, a company thrown in there for good measure. Is this the best way really to invest in emerging markets?
It depends what your horizon is and what your sophistication is. If you're willing to go into the local markets and you can buy companies that are listed in Hong Kong and places like that, that's a better way to construct your portfolio. Also, remember, it's a U.S. dollar-denominated ETF, so you're kind of doubling down on this currency trade as well. So if you can buy local shares, that's a better way to customize a portfolio.
Let me ask it a different way. Is this really an emerging? I know they want to sell it one way. Is it really an emerging market ETF, or is it a heavy China technology ETF with a little bit of other stuff thrown in?
Oh, it's really an emerging markets ETF. I think it does reflect the relative weightings that people put on the different emerging markets. There's a Brazil component in there. There's obviously a heavy Asia component, as there should be, given the importance of Asia in the emerging markets world.
David, though, if you take a look at the performance of the FXI in recent weeks, it's been just terrible. What turns that around? I mean, is that just all concern about a possible trade war?
I don't think so. I think it's a combination of concern about a trade war and strength of the U.S. dollar. Those are the two big things. FXI is a great example of what you were talking about just before, an index that people really need to understand if they're buying it, because that is very heavy Chinese banks and Chinese energy companies, both very state-owned. I think you'd be better off in Hong Kong with the Hong Kong China Enterprises Index or HSI itself, the Hang Seng Index.